Divorce often brings emotional and logistical challenges, but it also carries real financial implications. Ones that are easy to underestimate in the middle of everything else going on. This is especially true for people divorcing later in life, sometimes called gray divorce. And it's more common than you might think. As of 2026, adults over 50 now make up 36% of all divorces in the U.S., and for adults over 65 specifically, the divorce rate has actually tripled since 1990, even as the overall divorce rate has fallen to its lowest point in 50 years. Separation at any age can shift your financial picture. You might find yourself managing money that a spouse used to handle, rethinking your retirement timeline, or facing tax and legal questions you've never had to think about before. This video is here to walk through the practical side of it, clearly and simply, so you have a real starting point. If this is helpful, please like the video and subscribe. It may help someone else going through the same thing. Let's walk through it together. Divorce often calls for a full reassessment of your finances. That can feel like a lot. But getting a clear picture of where you actually stand is one of the most useful things you can do early on. Start simple. What income do you have coming in? What are your regular expenses? And what do you owe? This might include your job income, any spousal or child support, and any income from investments or rental property. Understanding your actual monthly cash flow helps you see clearly what might need to change going forward. It also matters to understand the difference between marital assets and separate assets. Marital assets are generally anything acquired during the marriage, retirement accounts, property, joint investments. Separate assets are usually things owned before the marriage, or received individually through an inheritance or a gift. The exact rules vary by state, so good documentation matters here, and it's worth gathering account statements, property deeds, mortgage paperwork, insurance policies, and loan agreements as you go. Include anything that might not be obvious at first glance, too. Like a personal loan or a stake in a business, the goal is a full, honest picture, not a partial one. Dividing things up in a divorce isn't just about splitting everything evenly down the middle. Different assets come with different financial and tax considerations, and understanding each one helps you make more informed decisions, rather than just aiming for a number that looks fair on paper. The family home often carries both financial and emotional weight. Selling it, transferring it, or buying out your former spouse's share all affect your future cash flow differently. So it's worth thinking through the home's equity, the mortgage, and any tax consequences before deciding. Retirement accounts, 401s, IRAs, pensions usually need a specific legal document called a Qualified Domestic Relations Order, or DRO, to be divided properly. This part is worth taking seriously. A DRO that's drafted incorrectly can trigger real tax penalties, sometimes more than 10% of the account's value, plus early withdrawal penalties if the person receiving the funds is under 59.5. This isn't something to handle with a generic template. It genuinely benefits from a professional who does this work regularly. Brokerage accounts work differently. They're more flexible than retirement accounts, but they can trigger capital gains tax when sold. It helps to know the cost basis of each investment before agreeing to a split, because two accounts that look equal in value on paper can end up worth quite different amounts after taxes. Pensions and annuities often involve long-term income streams and contractual rules that aren't always easy to divide. Some annuities carry surrender charges, and not all of them can be split at all. These details are worth clarifying early, with legal guidance, rather than assuming they'll work like a typical account. Life insurance matters too, especially a policy with cash value. It's worth understanding who owns the policy, whether it's term or permanent, and who's named as the beneficiary, and know that some divorce agreements require certain beneficiaries to stay in place for a period of time, particularly when support payments are involved. And Social Security is worth knowing about if your marriage lasted 10 years or longer. If you meet certain age requirements, you may be able to claim a benefit based on your former spouse's work record, generally up to half of what they'd receive at their full retirement age, provided that's more than your own benefit would be. This doesn't reduce what your former spouse receives at all, and you generally need to be 62 or older and currently unmarried to claim it. If you're getting close to that age, it's worth a conversation with a financial professional to understand your options. Taxes can quietly shape how much a settlement is actually worth to you, even when two options look equal on the surface. Different accounts are taxed differently. Money in a traditional IRA or 401 is generally taxed as ordinary income when it's withdrawn later, which could mean a larger tax bill depending on your income at the time. A Roth IRA, by contrast, can offer tax-free withdrawals if certain conditions are met. Brokerage accounts are different still. You're generally only taxed on the actual gain when you sell, often at the lower long-term capital gains rate if you've held the investment long enough. Annuities can be more complicated, especially ones that have grown significantly or include extra benefits, and some carry real penalties for withdrawing early. The home deserves its own mention here, too. Married couples selling a primary home can generally exclude up to $500,000 of capital gains from tax. For an individual, that exclusion drops to $250,000. Because of this gap, some couples choose to sell the home together before the divorce is finalized, specifically to use the larger exclusion. It's not the right choice for everyone. Market conditions, emotional readiness, and where you'll live next all matter too, but it's worth knowing the number exists before deciding. One more thing worth understanding clearly: alimony is taxed very differently depending on when your divorce was finalized. For any divorce finalized after 2018, alimony is not tax-deductible for the person paying it, and it's not taxable income for the person receiving it. A real shift from the older rules, which still apply if your divorce was finalized before 2019 and hasn't been modified since. If you're not sure which rules apply to your situation, this is exactly the kind of detail a tax professional can clarify quickly, and getting it right matters for how you plan your own budget going forward. A qualified tax advisor or financial professional working alongside your divorce attorney can help make sure decisions about dividing assets actually reflect their real after-tax value, not just the number written on a settlement worksheet. Divorce isn't just about dividing what you have today. It's also a good moment to look at your estate plan and make sure it still reflects your life now, not the life you had before. Wills, trusts, powers of attorney, and healthcare directives often name a spouse in an important role as executor, trustee, or the person authorized to make healthcare decisions for you. After a divorce, those choices may no longer reflect what you want, and updating them helps avoid confusion, or worse, a conflict down the road. If you have young children, it's worth revisiting any guardianship instructions in your estate plan too. Custody itself is decided through family court, but your estate documents can still guide what happens if something happens to you, and it's worth checking that this part still reflects your current wishes and your family's current situation. And beneficiary designations deserve real attention here. Retirement accounts and life insurance policies typically pass directly to whoever is named as beneficiary, not through your will. It's worth reviewing every one of these and updating them if needed. That said, some divorce agreements actually require certain beneficiaries to stay in place for a period of time, especially where support obligations are involved, so it's worth working with your legal and financial team before making any changes here, rather than updating things on your own and accidentally violating your settlement agreement. Divorce touches a lot of financial and legal decisions at once, many with consequences that last for years. Having the right people in your corner makes a real difference in how manageable this feels. Beyond your divorce attorney, it's often genuinely useful to bring in a financial professional, a tax advisor, and an estate planning attorney. Each one sees a different piece of the picture. A financial professional can help you understand the long-term impact of different settlement options, A tax advisor can explain how dividing specific assets affects your future tax situation, and an estate attorney can make sure your legal documents actually get updated the way they need to be. When these people talk to each other, rather than working in separate silos, you end up with a plan that actually fits together, instead of individually reasonable decisions that quietly work against each other. This kind of coordination is what catches the details that are easiest to miss under stress, like an outdated beneficiary form or a retirement account split that triggers an unexpected tax bill. Divorce can create an unexpected pause in the normal rhythm of your life, forcing you to rethink plans, priorities, and responsibilities you may not have questioned in years. It's a lot, and it's okay for it to feel like a lot. Rebuilding your financial life afterward isn't about starting completely from scratch. It's about taking what's already in place, figuring out what needs to change, and moving forward with a bit more clarity than you had before. That might mean building a new budget, rethinking your retirement timeline, or simply learning more about finances that used to be handled jointly or by someone else entirely. There's no single right way to do this, and everyone's path looks a little different. What matters most is taking the time to actually understand your options, rather than making quick decisions just to get the process over with. For a lot of people, this transition, difficult as it is, also becomes a real chance to define what financial independence looks like for them on their own terms.